It's going to be a quick discussion because I'm going to have more on this later for Blueprint owners and Fusion subscribers as well. This came from Alberto. Alberto wanted to know, by using power options, what is the best way to pick a married put that you would use for income versus a married put or radioactive profit machine that you would use for growth? Okay, fantastic. So right away, when you open the married put search, the default married put search on power options, this is based on our default criteria for the positions, okay, that we look for, that we talk about in the blueprint, that we prefer to use in those scenarios. So we go to married put and we go into the search tool. Okay? And we see here Ernie's in Marvel right now. I want to say he's in Jazz. I can't remember. I traded Trex 2 years ago, actually. It's kind of alarming that none of my current positions are in here, but they might be on page 2. Okay. But in any case, when I'm looking at this list, I can tell you right now there are 4 or 5 potential ones that I'd be using for growth and expecting slower movement, not have higher income. And there's about 9 to maybe 10 I see that I'd probably be using for income if I could enter those trades. How can I do that? Just by looking at it. When you talk stocks, when we talk stocks here, talk to Fernando, we talk to William, we talk to Sam, we talk to others. Alberto, when you and I talk, when you talk about positions that, we say, hey, well, Tesla was a good trade and this was a good trade. Hey, I made money on this trade and it just rocketed up and we saw some big movements in the last couple weeks and things of that nature. What doesn't typically see a large movement? What you and I might refer to as water cooler stocks. American Express, Bank of America, Bristol Myers Squibb, Applied Materials, and I may even say the one that Ernie is in right now, Marvel Tech Group. Although this one is probably have some good income and some good premium as well. These are positions you know. These are large cap companies, what we call water cooler stocks, blue chip stocks, things of that nature. I'm not saying that these aren't bad trades and I won't trade them as a married put, but the minute I see those type of trades, common names, to me, this is something that I would be in, buying the year output on most of these. I would evaluate the year output, the January 2022 puts, for a longer term holding, expecting growth if my market outlook and market sentiment is growth to bullish in these situations. This, a name that you know, a name you're familiar with, a large cap stock, that to me is a growth RPM. My favorite growth RPMs that sometimes I go back to, you may have seen this already if you're a Fusion subscriber. Kraft, traded it twice in the last 6 years, both profitable RPMs. I was almost going to enter back into it today. I was in essentially a bull put credit spread on Kraft to get back in after the married put had been assigned on the short call. Johnson & Johnson is one that's been successful for me twice. Ironically, in the old days, was it Avis? No, it's not Avis. I'm sorry. It's either Hertz Rental or the other rental company, the car company, that paid a dividend. It was a really good growth one. It took more time. And because it's growth, what does that mean? Lower implied volatility, lower stock volatility, which means lower premium compared to other positions. Chegg, Jazz Pharmaceuticals, is probably going to be more of an income position. It's going to have higher premiums, and you're probably looking for faster growth on this stock, meaning you might hit your targets of 3, 6, 8%, maybe 10% stock growth in 2 to 3 months, as opposed to maybe expecting it to be 4 to 5 months. And that's why I'd be wanting to be out in January with the more growth positions, and I'm okay going shorter term with the more high flyers. Trex to me is more of a high flyer, has more volatility, it fluctuates more in price. This one was barely a successful RPM for me because I think it was down 15 to 20% in the 2 months I was in the trade. And I think we got out with a 1% return or a 0.5% return. I'll have to check that at some time. I'll have more on that for Blueprint owners, Alberto, later, but that's my approach for looking for growth versus, oh, there's Darling. Yeah, Darling is there. That's one of the ones that I'm in. Second page, Apple, more growth. Lowe's, growth. Darling, Fortinet, Teradyne, I'd consider those shorter term income protected put positions. Okay. And again, I don't see the one here for Apple out 372 days, but Lowe's is. So I'd want to look at the January position for Apple farther term to see what risk matches my criteria, because I consider that more growth. Yes, it has income. Yes, it probably has good income on occasion, both weekly and monthly. But these higher flyers, you're going to see more relative time value for the income methods than we'd expect to see. You know, with Darling, Fortinet, Teradyne, I'd expect to see more time value, more at the money premium with those than I'd expect to see with American Express, Bank of America, Bristol Myers Squibb. That's how I make the decision process there, Alberto, in this.